So I will say, by the way, I want to say, because James said we're both kind of bearish here, I'm actually bullish for now. I like to say with that little caveat, for now, I'm bullish, and we can get into the whys of that for
Mhm.
now. But
Oh
I
yeah,
think
let's
that,
do it.
well, should I jump right in, and then
Yeah,
Yeah.
we
I
can
want to
talk.
hear your bullish take. I would
Bullish for
love to
now.
see it.
Okay.
Yeah.
Okay. So
Yeah. Yeah.
I am of the opinion that everything changed in October. So basically, what had been happening from Q4 of 2021 into October of 2022 is liquidity was contracting throughout the globe. And in October, September 30th to be more exact, everything changed. It bottomed right there, and then since then, the liquidity, at least by the way, I follow things, both global liquidity and even I would say sort of stealth QE here in the US has started again. And so you can see the effect of that across all of the major asset classes, at least the ones I care to pay attention to. The dollar peaked at sub 115 right around. So this is all right in that time frame. Don't hold me to September 30th, but so around the time frame of October, the dollar peaked sub 115 and has been coming down. VIX basically peaked the volatility and has been coming down. Bond yields peaked and have been coming down in general. They've been trending lower. Risk assets generally across the board, both in the US and internationally, Chinese markets, European markets, emerging markets in general, all kind of bottomed and they've been in, at least the way I look at things, they've been in a channel of expansion since that time. They've been actually doing quite well. Bitcoin, I think, would have bottomed in October, but thanks to scam, bankster fraud, it pulled it down for like another month or so. And that kind of, I just think it was like it was trying to get up above the water and it pulled it down for another month. And so now, so Bitcoin was mad. So then it started surging it come December, and it's been obviously it had a nice run. We're pulling back here a little bit. But so in general, I think the trend currently for now is up, and I'm bullish in general. I think like even right now as we speak, it's the 13th of February, so the day before the CPI comes out. To me, it looks like things have in the very short term have gotten a little too bearish. I'm actually more optimistic that when the CPI gets announced, that we may have a surprise to the upside for risk assets. And I hate to make calls like this because all it does is make me look stupid when I'm wrong, and I probably will be wrong. But I think that we may have a bit of a run until that what we're talking about, this recessionary bear market sets in. I definitely think a recession is ahead of us still. I don't believe that we're going to have a no landing or even a soft landing. I think we're probably going to have some kind of a harder landing at some point. But I think risk assets may do well for the coming, I don't know how long, days, weeks, quarters, possibly, maybe a year. I don't know how long, but at some point we have to pay the bill. But in the meantime, the music's playing, so I'm up and dancing.
That's good. I think, I so many of the data points that you mentioned there, Jeff. I agree, but I think that a lot of that has already played out. Now, I don't. Again, this is all probabilities. We play probabilities. I don't talk in certainties, because we don't. There's nothing certain in the markets. But just like Dr. Jeff just said, there's a lot of reason to think that many of these risk assets and the liquidity data points are pointing to a risk on atmosphere. Um, but you're starting to see certain market risks, certain economic risks creep in, and those are like things like Bank of America. I've got my notes over here somewhere. A couple of weeks ago, had just announced, they had talked through their earnings. And they're like, "Hey, look, um, maybe it was J.P. Morgan. I apologize. I can't remember which bank it was. It was one of the major banks, Citigroup, J.P.
Yeah. One of
Morgan,
them.
Bank of
One of the
America."
mega banks.
Yeah, and they said, "Look, the credit card, the debit spending was only up 1% last year, but credit card spending was up 22%, and credit card the credit card revolving debt was up 17%. So what you're seeing is there's a few things that are starting to play out. We're watching very, very strong employment numbers, but remember, I think that there are many managers who are shell shocked from being unable to actually hire people back during the pandemic. And I was talking to a guy who's in construction here. He owns a construction company, and he said, look, I don't want to let go of any of my employees because I could barely get them to come back when they got those stimulus checks during the pandemic. They're like, why am I going to go back to work? I'm living for free here. They're going to keep giving us checks until this whole lockdown is over. And so they had a real hard time. He had a really hard time getting and keeping employees. And even though the construction business was doing gangbusters in late 21, early 22. So that's one thing is I think that you're seeing companies and especially services who are they're reluctant to give up employees. They're afraid it's going to be difficult to hire them back, and it takes a long time to find the right people. And if you've ever been on the hiring side of the desk, it's not that easy to find the right people for the spots that you have. I mean, if you do it the right way. So that's one thing. But you're starting to see companies who don't really they're massive that don't really have a problem finding talent now in these days, which is the large technology companies. They're just laying off people in the 5s and 10,000s at a pop, and they're taking that spending risk off their table because they know they can just turn around and get them back. There are few other industries they can go to, if they're technology people. So you're starting to see that. And I think that what happens here is as the Fed continues to hold the screws on liquidity, net, there are ways that they're allowing some liquidity to leak back into the market, but I think they're doing that just to make sure that the Treasury market remains very stable and very liquid, and that is true. But as you keep that cost of capital high, eventually you'll see some of these watershed moments where you just have a drawdown in either liquidity of certain sectors and certain companies, large companies that just have some surprise downsides, and they start laying off people. And that, I think that's the risk, is that you have that watershed moment while you're super long, and you get taken out at the knees, and that's the issue for me, and that's the risk here. And so do I know it's going to happen? No. I mean, this is a crazy world we're living in, and I do know that the Fed and the Treasury can't let this market fall apart completely, because if they do, the tax receipts will plummet, and then our debt problem only gets worse. So they're walking this super razor thin tightrope over a
Yep.
canyon, and they know it. And so that's what we're all kind of watching. We're like with popcorn, but it's pretty serious. So